Welcome everyone again to this ShareCafe Hidden Gems webinar. We've got a good lineup of popular companies today. So what did we see last week? Well, we're kind of halfway through the reporting season. It seems all eyes are still outside of the ASX 200. There's also been a lot of press this week on the power of the self-directed investor, with kind of product issuers and brokers and ETF providers all looking at kind of digital pathways to target them directly. We've even seen it from some listed companies. It was kind of brought to my attention, like some of the ASX announcements these days are looking more like PR releases. One mining company, for example, had an ASX heading that was subtly titled, "The Giant Continues to Grow." So power of the self-directed investor is becoming increasingly valuable to kind of all market participants. Wall Street Bets, for example, that Reddit page that ramped GameStop, that originally had 2 million members when I looked at it a couple of weeks ago. It's now closer to 9 million members. Now that's a lot larger than the 6 million retail investors that own stocks on the ASX. That Reddit page now, of course, is littered with advertisements from brokers and ETF providers who can target those investors directly for a very small cost. So who knows where the market's going to end in 2021, but the rise of the digital investor is here to stay. Now we've got, if you want to ask a question of any of our presenters, they're 10-minute presentations, 5 minutes for Q&A. Type your question in the box and we'll get to it if we can. First up, we have a keynote presentation from Chester Asset Management. We have with us the portfolio manager, Rob Tucker. Rob is one of the founders of Chester Asset Management, which he founded in 2017. Rob, over to you. Thanks for your time.
Thanks, Tim, and thanks for having me on ShareCafe, and everyone, thanks for joining us. So Chester started in 2017, as Tim said. There's three of us. We've all worked together for almost 10 years now, having come out of a previous boutique operation in Melbourne. Chester has $180 million under management, and we run a very high conviction benchmark unaware strategy. So the same team has run the same strategy for over 7 years now. I might just switch to the next slide, thanks. So what we do differently, we think, than a lot of our peers is, one, have a life cycle approach. So it's a very broad cap portfolio construction, and we think very heavily about capital protection. So we run a defensive sleeve through the portfolio, which enables us to protect the portfolio in down markets, often better than a lot of our peers do. Over 7 years, the fund has outperformed 80% of the time in down markets. So we think we're able to provide really strong alpha with a lower volatility using the portfolio construction tools at our disposal. We might just flick to the next slide, thanks. So the strategy itself is an Australian equity strategy. We can hold up to 20% cash, and we often hold, well, it's 25 to 40 stocks, and typically that's 34 to 35 stocks. And again, if we flick to the next slide, with just the performance track record over the last 7 years, we've generated almost 15% per annum over the last 7 years. Clearly the last 12 months was relatively pleasing from an absolute return perspective. While those returns are pleasing, the alpha generation, what we really like to highlight is the chart on the bottom left-hand side of that slide, which just shows you the correlation with the index. So our correlation is 0.867 relative to the peer group, which is 0.94. So that's how much your portfolio reacts with the index. So our portfolio has very low correlation with the index, and that's reflected in the lower standard deviation and the lower portfolio beta. And we think that's a testament to the way we run the portfolio construction piece. So again, we've had really strong alpha generation with lower volatility than the overall market, and certainly our peer group. I'll switch to the next slide, thanks. And look, the way we do this, and this is relatively simplistic, but the way we think about portfolio construction, and we think it's going to be really important in 2021. There's still a wide range of outcomes that can occur this year in terms of policy error and removing the world from the huge unprecedented stimulus that we had in 2020. So we have always allocated the bulk of the portfolio to what we call predictable cash flow growers. So those sectors are more likely to be healthcare, technology, infrastructure, gaming, staples, etc. Where a company has less predictable free cash flow or cyclical in nature, where it's energy or commodities or media or retail, we allocate a smaller part of the portfolio. And then we have always allocated a part of the portfolio to gold or an ETF that's non-correlated and cash. So we have a residual defensive sleeve that is positions that are non-correlated to the ASX 300. And we think that has really stood the test of time over the 7 years we've run this strategy. So if I just flick the next slide there. And again, in that context, this is how the portfolio has looked over the last 7 years. So the predictable part of the portfolio, those strong, visible, predictable cash generators, it's normally over 60% of the fund. If we're allocating money to cyclical stocks like mineral resources, that's always between 15 to 20% of the fund. And the defensive sleeve has tended to be 15 to 20% of the fund. So that's how the portfolio construction piece ties into what we think is a different offering than many of our peers. Next slide, thanks. I guess the other important point we'd like to make is that this is a broad cap fund. So in aggregate, it has a mid cap bias. So we do allocate a pool of capital to emerging companies. And we've got there as examples, Aurelia Metals, which we think is compellingly unloved at the moment. Certainly some growth companies that still have the ability to grow their revenues in an organic fashion, well above nominal GDP. And some mature companies where we think they have really strong industry positions. So that's how we sort of have a life cycle approach to the portfolio construction piece. Next slide, thanks. We can certainly answer these questions in Q&A if anyone's interested, but these are the top 10 holdings of the fund as of the end of December. Some of those companies might be well known to you, others less so. So what we'll do is call out a couple of these names we still think have significant upside over the next 12 months. But we certainly have to refer back to those companies if anyone's interested. Next slide, thanks. So the first one I'd like to talk about is OceanaGold. We were sort of interested in this in the low $3 range. And to be honest, it's been quite a problematic investment to this point. But what Chester does, we think, relatively well in terms of generating alpha, is finding unloved or undiscovered assets. So we think OceanaGold falls heavily into the category of unloved. And we see a really strong pathway because it's actually organic growth of their gold production growing from 300,000 ounces in 2020 to over 600,000 ounces in 2024-25. And that's, as I said, purely organic growth from their existing assets. OceanaGold has three main assets: Hale in the US, Waihi in the North Island of New Zealand, and Macraes in the South Island of New Zealand. They have an asset, Didipio, in the Philippines, which has been problematic in terms of having their mining license renewed. It would be a significant source of upside surprise if the Philippine government renewed their mining license in the Philippines. We exclude that from our valuation and our production profile. The main reason we think the market is getting this stock wrong is simply the world-class discovery they have at WKP, which is in close proximity to their Waihi mine in the North Island of New Zealand. They've had some spectacular hits, including 150 metres at over 11 grams a tonne. And we think this is truly unrecognised in terms of the value that will create for OceanaGold in the next 5 years. They've actually come out last year and said the production profile will grow from 50,000 this year as they restart the mining at Waihi to over 300,000 ounces by 2027 as they reach that WKP ore body. So using the Hale, which is going to produce 180 to 200,000 ounces, Macraes, which does 160 to 180,000 ounces, and growing Waihi from 50,000 ounces this year to over 300,000 ounces, we can see production of this company doubling over the next 4 or 5 years. So it's trading about $2.30 a share, and we see value genuinely above $6 a share. So we think it's well and truly in the camp of unloved and underappreciated assets. Next slide, thanks. This slide has probably changed slightly because News Corp certainly had a very strong run the last couple of weeks since it reported its 2Q results. But simply, we thought News Corp was incredibly underappreciated in terms of the assets it held in its stable. There's a very strong visibility of realestate.com, which News Corp owns 62% of. And realestate.com has risen from $40 to $160 in the last 5 years. Again, News Corp owns 62% of it. So while realestate.com was up 400%, News Corp went from $20 to $20 over that same 5-year period. So either the value of real estate to the News Corp company valuation was being completely unrecognised, or the rest of the portfolio was completely unrecognised. Now, the other main significant part of the News Corp asset base is a company called Dow Jones, which is the publisher of the Wall Street Journal and Barron's. And the green line there, if you can see the chart, is the New York Times, which is the closest comparable to Dow Jones. And Dow Jones actually had stronger subscriber growth than New York Times over the last 3 years. And that's sort of just new subscribers to the Wall Street Journal. So if we look at the way the market is trading the New York Times and the value of the New York Times, we think, including the live valuation of real estate, we think News Corp can easily be worth between $35 and $40 a share, using what we'd still consider to be relatively conservative cash flow multiples. So the earnings for News Corp last week were upgraded by 50% on not only realestate.com, but really strong cash flow growth out of the Dow Jones asset and HarperCollins Publishing, and even Foxtel, which is showing signs of life. So the complete portfolio of assets within News Corp, we think are really starting to be recognised properly now, but we still think there's more to go in 2021. I might just flick to the next slide if we can. And I'll finish with this slide, and then I'll take some Q&A. So where are we today? So these are the main themes we're looking at. Clearly, it's very apparent that the Australian economy is flying. So if you look at building approvals and consumer confidence, car sales, etc., we've exited 2021 better than any other developed nation. The RBA language from last week suggests they're going to let this run into the first half of this year. So I think it really augurs well for sectors and stocks that benefit from this economic tailwind that we're currently experiencing in Australia. Probably the biggest wild card in 2021 is what happens to inflation. Given the money supply growth that happened in 2020, how does that manifest itself as the world becomes unlocked, or people start remobilising after lockdowns in the Northern Hemisphere, after the vaccine has been rolled out across those populations in Europe and the US. So once we think we see people moving again, we think that's when inflation really starts rearing its head, and that probably would be really cause for concern on these higher value, long duration assets, the tech companies that have seen such unbridled enthusiasm for the last 5 or 6 years. So we think this year is far more likely to see a rotation in style because of the inflation that's going to be caused in the second half of 2021. The last point I'll make is, we've always been relatively cautious on technology because we think it's a very asymmetric bet. The winners take all, i.e. an Amazon, and there is a large cohort of investors right now willing to bet on loss-making tech companies in the hope that they get that asymmetric payoff. So we think there's a large amount of tech companies listed, both in Australia and the US, that are loss-making, and we don't see the visibility of how they become profitable in the next 3 years before they actually get disrupted themselves. I'll use a very quick example, and then I'll throw to Q&A, but if you look at a company like Tyro Payments, which is actually a good business, it's a terminals business that provides FPOS facilities for cafes and restaurants. So this listed last year with a $1.5 billion valuation. It's loss-making. Through COVID, obviously those cafes and restaurants were shut down. But what happened through COVID was an app-based product or solution created by Square, a US company, that allows you to go to a cafe or restaurant and order your food and drinks from the app on your phone. Therefore, the terminals that you're going to pay that we're using Tyro are no longer being used. And so we think Tyro is actually a business model that was loss-making, that has been disrupted in the last 6 months because of the changes to COVID rules and the way waiters actually bring food and drink to your table. So we're always very cautious about overpaying for assets that we can't see what they look like in 3 years' time. And I think it's going to be one of those trends to watch in 2021. So I'll leave it there. I realise I'm slightly over time, but I'm happy to take some Q&A if there's time.
Thanks, Rob. So that defensive nature of your portfolio, how did that perform during the March volatility and the downturn?
Yeah, so Tim, and I think that's what I've sort of referred to in terms of having our portfolio having lower volatility. If you look at March, for an example, I think the market fell 21% or something of that magnitude in March, and our portfolio fell about 16%. So it's certainly, we are a long-only product, so we're not going to be able to have gains in that particular period of time, but we've been consistently able to demonstrate that we fall less than the market in those volatile periods, and that's largely gold. Now, gold has actually been a really problematic investment the last 4 months because it's been used as a funder for the cyclical recovery taking place. But if we see inflation occurring in the second half of 2021, we think gold is absolutely going to have its time as a portfolio holding again, and a lot of people will revisit it. So we think it's certainly very appropriate to have an allocation to gold in the portfolio.
And there's a couple of generic questions here on your view on tourism and travel stocks.
Yeah, again, so I haven't been particularly enamoured with the travel stocks, largely which is sort of looking at corporate travel and Webjet particularly. They did such a large capital raising in March, April. So I think you'll find the market caps of both those companies are well and truly above the market cap at their peak last January, February, because of the number of shares on issue. So we think that probably, given the uncertainties around how travel opens up and the lack of confidence I'm seeing and talking to people about what their business travel intentions are over the next 12 months, I still think there's a large range of outcomes in terms of what travel looks like the next 12 months. So for me personally, it's just a little bit early to wade into those particular stocks. I have taken a position in Sky City. I think it's unloved, but if you look at what they were earning in 2019, Sky City's only ever had 5% of their revenues from VIP or international travel. So 95% of it is the domestic market. And so we think as Auckland, people are moving about in Auckland again, those Sky City casino numbers should stabilise. And I think there's probably 30-40% upside to the Sky City share price from here.
Okay, great, Rob. That's unfortunately all we have time for. We've got some follow-up questions, particularly in regards to what platform your fund can be found on. So we'll follow up with you in regards to those questions just later on.
Very good. Thanks very much, Tim.
Thanks, Rob. Next up, we welcome back Genetic Signatures, market cap of 262 million, ASX code GSS. It's got a 1-year return of positive 56%. We have with us the CEO and director, John Melky. Genetic Signatures, of course, is a specialist molecular diagnostics company focused on the development and commercialisation of its proprietary platform technology, 3Base. John, good to see you again. Over to you.
Yeah, thanks so much, Tim. Thanks for that intro. Thanks for having me back. Always a pleasure to speak to you. Always a pleasure to talk about Genetic Signatures, Australian company that designs, develops tests for infectious diseases, which we manufacture here in Australia and sell around the world. Our tests are a molecular test, and all that means is that it's a test that detects the genetic information of the organism. So that's the DNA or the RNA of the organism that makes us sick. So we is a molecular test, but we have developed a technology over the last 15 years, which we call 3-base, which gives us an advantage over other molecular suppliers in that we can more easily detect groups of organisms from the one patient sample. So our 3-base technology goes into kits that we make, which are listed there on the right-hand side of the slide, where each kit is able to detect a large number of organisms from the one patient samples. So our enteric kit, for example, this is gastroenteritis, or I guess viewers might know it as food poisoning or similar. That can be caused by many targets. Our kit can detect over 20 of those effectively in the one test, from the single, and test for them simultaneously from the one patient sample. So these are sort of syndromic panels. We look for organisms that cause disease in certain conditions, such as gastro-respiratory, which includes influenza and SARS-CoV-2, the organism that causes COVID-19. We have tests for ESBL, or antibiotic resistance, sexually transmitted infections, etc. And we are now marketing these kits around the world in our expanding team. In fact, our team has almost doubled just over the last couple of years as we pursue expansion from Australia into Europe and North America. So the next slide will give you a visual of what our kits look like. The kits contain everything that the lab needs to perform the test. And when I say lab, I'm talking about a pathology service provider. These are either hospital labs or dedicated labs that take patient samples and look for a presence of an infectious disease. So everything's included. The business model for our listeners today is quite simple. We make these test kits usually in lots of 500. We receive purchase orders from our customers, we fill them, we're paid on standard 30-day terms. We don't do any testing here, we simply make the test kits. The pathology lab will use our test kits on any sample that comes through the door, any patient specimen, and this could be thousands a day. And they get reimbursed either through government reimbursement programs and sometimes even private payers. We've also developed instrumentation. Although our tests are platform agnostic, they work on equipment that is commonly in labs, but we have developed equipment which has a very desirable workflow for the end lab, and it's really targeted towards those mid and high throughput laboratories, those who are doing hundreds, if not thousands, of tests every day. It has been a busy 12 months for us, given that COVID-19 commenced about a year ago, and the gold standard test is a molecular test, one that directly detects the RNA. So the next slide will take you through our last 12 months, which has been extremely busy for us. Not even 12 months ago, back in March of 2020, we announced first shipments and regulatory submission for our COVID-19 test kit. It detects the virus SARS-CoV-2, which causes COVID-19. We received those regulatory approvals in April, both in Europe and Australia. In June, we're included in the ASX All Odds Index. In June, we recorded quarterly revenue, which was up 351% on the prior corresponding period. Only to outdo that in the September quarter, which was up 585% on the prior period. And again, only to outdo that in the December quarter, where we're up 744% on the prior period. We have a breadth of tests, as you saw. We continue to develop our other tests, non-COVID tests. And just last month, we received a CE-IVD clearance, or CE-IVD mark, for our STI genital pathogen detection kit. In terms of revenue breakdown, that's on the next slide, where I've shown you 4.5 years. So the final column there is the first half of FY21, where the other 4 are just the full years. And you can see that large uptick in revenue. It's really from that strong demand for our tests. In first half of 21, we've had multiple waves in Australia, but also in Europe and America, where we are now active. We have installed multiple new units across all the jurisdictions that we're active in. And that's Australia, Europe, and the US. And these instrument placements go into busy labs, and primarily at the moment during the pandemic, they're being used for SARS-CoV-2 testing. although we fully expect and focus now on converting those customers into using the rest of the kits that we have regulatory approvals for and use exactly the same workflow. We've reported the last two quarters were positive cash quarters. We have a cash balance of 36 million, which really allows us to aggressively chase the offshore expansion in those much larger European and US markets. So for the rest of the time, I'll just spend a minute or two on each of the jurisdictions where we're active in. The next slide will take you through Asia Pacific. We are an Australian company. We have been selling tests in Australia for longer than anywhere else in the world. So it is the majority of our revenue. First half 21 was just over 15 million, up from 2.5 million in the prior corresponding period. I mentioned back in March of 20, we did receive TGA registration for our SARS-CoV-2 detection kit. We're quite quick in developing that kit and getting the regulatory approval, and that has really underpinned the strong growth that we have seen, not only for that organism in particular, but also the entire respiratory portfolio had an uplift as our customers were choosing to look for other organisms that may cause respiratory symptoms, such as influenza or rhinovirus. We are an Australian manufacturer, and we have significantly increased production capacity over the last 12 months, and there is more to come. And as I've said, we are continuing to develop our new test kits for different syndromes, such as the STI, sexually transmitted infection kit, which we have lodged with the TGA. The next slide will take you through our European business. It is a focus for us, has been for the last 12 months. Again, we were in a position where we were able to get CE-IVD approval relatively quickly. That was March of 20. My apologies, that date is wrong on the slide. And that led to sales in Europe of 3 million for the first half, compared to only 100,000 in the 12 months prior. Europe is now representing 16% of our global revenue, and to me, that's just the beginning, given that Europe and the US are multiples of the Australian business, where we are now well and truly established. We are choosing customers strategically. We are targeting those customers that have mid to high throughput, and those customers that would benefit from bringing on more of our tests as the pandemic becomes under control. As I said, we have recently announced only last month that we did receive CE-IVD registration for our STI genital pathogen kit as an example of how we continue to develop and bring new kits to market. The next slide is on our US business. It is certainly focused on building our US business, as North America is the biggest molecular market in the world. Over 40% of the global molecular market is the US. And we were therefore delighted in only about 8 weeks ago to announce our first customer in the US using our SARS-CoV-2 test. And even more delighted only 3 weeks after that to announce that we'd acquired another customer. Those that know me know I always say the first customer is always the hardest in any new region, and we've done that now in North America. Contributed 600,000 in the half, bearing in mind that we only brought them on in December. Continuing on with clinical trials for our enteric protozoan kit, which is the kit which can look for protozoan infections causing gastro, and that's going to go through full 510K FDA submission. We've appointed a Canadian distributor and established a new warehouse in Los Angeles, non-stop flight from Sydney. The next slide really is just to remind you of the breadth of products that Genetic Signatures makes, whether it's enteric, respiratory, STI, and you can see on this slide the significant addressable market for each of those. And excitingly, some of those are still emerging markets, such as the antibiotic-resistant test. They are estimating that there'll be more deaths from antibiotic resistance than cancer by the year 2050. So the really, I think, potential for these to turn into very significant markets for us. So in conclusion, I will just on the next slide, just take you through our focus looking forward. I think I've shown you now there are multiple growth opportunities for us to pursue. Our focus is on winning those long-term customer contracts, delighting them so they'll take on more of our assays as they can, if they haven't already, as the pandemic winds down. But we're certainly leveraging that COVID-19 momentum. We are promoting the new tests that we have coming through, and we are actively bringing new tests to market, either through FDA submissions for protozoan kits, for our STI genital flavivirus, and some kits that we have not yet announced to the market. So I'll pause there, Tim. Happy to answer any questions.
Thanks, John. A truly fascinating business. Now, there's a theme here in terms of questions. Obviously, there was a kind of a COVID tailwind with your COVID testing kit that the company was innovative enough to have released quickly to the market. So there's a question here, basically there's a vaccine in the market. How will that impact your COVID-related kit sales? And can you kind of balance out a potential fall in those sales with the new kit, the new testing kits that you have for other diseases?
Yeah, no, it's something that we're actually very focused on, Tim. We do understand the pandemic won't be forever, and that's a very good thing. We do understand that testing isn't going to go away even post-vaccine. You mentioned the vaccine. There's certainly flu vaccines. You're encouraged to get them every year, but we do have a flu season every year because for multiple reasons. The first is they're not all 100% effective. And so if someone's displaying symptoms, you have to do a test. And there are many different organisms that will give you the same symptoms. I described in the presentation, whether it's local or international, that the new customers that we have on are being encouraged to take on those new kits that we have or existing kits that already have regulatory approval. So why test for only SARS-CoV-2? We can also test for influenza or RSV or any other number of respiratory organisms. And that is very, very important, especially if you're the poor patient who has symptoms and is told they have a negative COVID test. It doesn't make them feel any better, but telling them they have the common cold generally does.
And what's your kind of forecast annual sales growth for this year?
We haven't released those forecasts because it is obviously in the middle of a pandemic. It's very difficult to know what's happening week to week. We are of the view now that this is not going away anytime soon. I think there's another couple of years left of strong demand for COVID-2 testing, and I think that will then evolve into SARS-CoV-2 becoming just one test of many that are being done on any clinical sample, of which we're very well prepared for, and I'm certainly excited to see where we get to.
And could you give a little bit more colour, if you can? This question here on when do you expect the FDA? I know you can't give any timeframes, but when do you expect the FDA to allow the sale of the kind of non-COVID tests in the US?
So before we can, the FDA can consider this, we need to finish the clinical trials that's being performed in 3 US-based sites. We have had delay because of COVID-19. The test sites which were identified before the pandemic obviously were swamped, and we had to push those trials. We are recommencing those trials now. Some sites are better able than others. Some are still swamped. So we're not able yet to give any indication. By the time we finish the trial, write up the application to the FDA, it should be within a quarter after submitting that we hear back.
And is that a separate application process for each individual kit?
It is in the US, correct. Every kit is a separate FDA application. Slightly different in Australia and Europe, where you sort of have a banner for respiratory kits or STI kits, and you can add kits under that same banner.
Great, John. That's all we have time for. Really appreciate you coming back. Good luck with this year.
Thanks so much, Tim. My pleasure.
Thanks, John. Next up, we have Silver Mines Limited, ASX code SVL, market cap of 286 million. Lots of talk around silver over the last couple of weeks. The stock has had a 1-year return of plus 175%. The company focuses on the development of quality silver projects, maximising leverage to the silver price. We have with us the Managing Director, Anthony McClure. Anthony, over to you.
Thanks very much, Tim. And we're first timers on ShareCafe, and I'm sure you'll find this presentation of interest. Just in summary, we've got two principal projects that we're looking at. One is a silver mine development. The Bowden Silver Project in central New South Wales is the largest undeveloped silver project in Australia and one of the largest globally. Exploration is very much part of what we do, and I'll go into a bit more detail in what we're doing on exploration, but we've got a particularly interesting program going forward. Next slide, please. Just a snapshot. Tim mentioned we've got a market cap a bit over $280 million. We're in a trading halt at the moment. We're doing a capital raise at the moment, which will be announced completed and announced on Monday morning. On the register at the moment, North American, Sprott and Brick Lane, Conway, which is the Gold 2000 fund out of Zurich, Regal and others. So well supported from an institutional point of view, and that's expanding, and in particular in North America. Our background is very much in mineral exploration and mine development. We've got very strong representation on our board. Next slide, please. So the Bowden Silver Project, central New South Wales, about 3.5 hours drive from Sydney, so nice and local. New South Wales is known more for its coal. The Port of Newcastle is the largest export coal terminal in the world. However, outside of coal, there is some large developments. Cadia Ridgeway is one of the best mining operations, gold and copper, globally. Then you got Cow, Evolution, North Parks, and so forth. We're not Western Australia, but we do have significant mineral developments in New South Wales. Bowden's is certainly something that is of particular size that gets up there with those large operations. Next slide, please. So Bowden's itself is 100% owned. We've owned the project for a bit over 4.5 years. The mineral resource is 270 million ounces of silver equivalent. Of that, about 160 million ounces of silver. The project is vast. As I mentioned, it's the largest undeveloped silver project in Australia and one of the largest globally. We've completed our feasibility, robust economics. We've completed our development application. Environmental impact statement has been submitted. That was in May last year. And the primary aspects of the EIS show particularly positive outcomes, whether it's from an economic point of view or an environmental point of view. We've got strong support locally, which dictates strongly a clear path towards development approval. So we expect to have development approvals through the course of this year. Next slide, please. So back in time, so we took over the asset mid-2016. Previous owners had spent a reasonable amount of money on the project. Kingsgate Consolidated owned the project. They bought the asset for 75 million. They spent about another 30 million on it. We bought the asset mid-2016 for 25 million. So that's representing primarily the drop in the silver market, but obviously we're in a different realm, which I'll touch on in a moment. So when we took over, the principal objective for us was not only mineral exploration and understanding what we're dealing with, but development of the resource. So within the first 12 months, we added about 100 million ounces of silver equivalent to the resource. That moved straight into the feasibility, which was complete in 2018. And since then, further exploration, but primarily the development of the environmental impact statement, which, as I say, was submitted in May last year. So we're at the tail end of the approval process. We see nothing in the way to have that approved shortly. Next slide, please. So the feasibility study, as I say, 2018, robust economics. We're tapping into about 30% of the measured and indicated resource. So that's indicating the size of the deposit. Our kick-off is at 2 million tonnes per annum. Over the life of mine, we'll produce over 50 million ounces of silver, plus zinc, plus lead, but expandable. So, in the course of the ensuing years, we'll have more details that will show on that, but I'll explain a bit more on that in the exploration section of the presentation. Next slide, please. More of the metrics from the base study. Next week, we'll have further information of how these metrics will look at current silver pricing. So 2008, we're dealing with a $20 silver price, and now silver pricing is about $27, $28 US per ounce. So the metrics at today's pricing are particularly favourable for this project, as you would expect. Next slide, please. So getting into exploration, next slide. We just put it further on the map. So the mineral developments in New South Wales are within the Macquarie Arc of New South Wales. So Cadia Ridgeway, Cow, North Parks and other deposits primarily on the western limb of the Macquarie Arc. We're on the eastern limb. That's recently been proven by us and in collaboration with University of New South Wales. So we own about 2,000 square kilometres of the eastern limb, and we have demonstrated now that indeed it is that eastern limb, same rock, same structure, same mineralisation styles, and however poorly explored. A lot of work, a lot of money has been invested in the Bowden Silver project, but the rest of the portfolio, a lot more exploration work is required, and that's part of our planning moving forward. Next slide, please. Putting it further on the map, so we're near Mudgee, central New South Wales. Bowden Silver project in the bottom quadrant of the tenement block, as I say, 2,000 square kilometres. To the north of us is Golgong. Golgong's an old gold mining centre. As we move further south in our tenement block, we get into other mining districts, lead, silver, molybdenum, copper, and so forth. As you reach further south, more silver, zinc and lead. And that's effectively the centre of our universe is the Bowden Silver project. Barraballar in the north is a exploration copper gold porphyry target that's got potential signatures of Cadia Ridgeway. Next slide, please. So zooming in, the Bowden's project in the bottom there, we're in a zone of crustal extension, which is deriving mineralising fluids, and as I say, the bulk of the work has happened at the Bowden Silver project. But as we get further afield and moving to the north, we see other mineralisation styles from surface. And that's dictating exploration projects going forward. Next slide, please. This is some of the work we're doing at the moment. So we've got 2 rigs on site, and this is looking directly under the pit, which is shown in yellow. We've got a 10,000 metre program that will roll forward into further exploration, given the success we've been reporting over the last period. Next slide, please. And this sort of sums it up. So the blue area there is the proposed open pit, and mineralisation directly underneath continues. As I mentioned before, the open pit is tapping into 30% of the known resource. But where we're drilling now, and this is outside of the resource primarily, we're seeing what we consider to be a feeder zone to the mineralisation closer to the surface. So sort of below 200 metres down to 450 metres, we're seeing quite spectacular grades of silver primarily. We announced a couple of weeks ago one hole that was 26 million at 250 grams silver, including 10 metres at over 400 grams silver. So you're getting those sorts of grades. We've now determined this area to be about 200 metres by 300 metres, with a thickness that ranges from 1 metre up to sort of 25 metres odd. So what we see in this area and what we're hoping for in this area with further work. And as I mentioned, we've got 2 rigs on site at the moment, but the further work is designed to hopefully scope this area out for a future underground, high-grade underground development. So we're particularly excited about this. Some of the previous results, 4 meters at 1,000 grams silver equivalent. That's 4 meters at 30 ounces silver, and that's extremely positive, extremely high grade in any language. Very unusual for this part of Australia to see this sort of grades and volume of the grades. So as we move forward, we're stepping out. We're, as I mentioned, 2 rigs on site. We've got several holes that have been complete. Assays are awaited. And as those arrows dictate, the system is very much open as we get deeper. So a lot more work to come out of this, and a lot more results. We'll have a steady stream of exploration results over the ensuing period and throughout the balance of this year. Other exploration, there's more detail in the presentation. I won't go into that right now, but at your leisure, please go through that and see what we're doing north of Bowdens. We've got another project south of Orange that we've just completed our initial drilling. I encourage you to get online and have a look at the detail that are public releases, and please get in contact if you have any further information. Back to you, Tim.
Thanks, Anthony. Appreciate you being on time there. There's obviously a few questions around the trading halt. Can anything be disclosed, or nothing as of yet?
Yeah, well, as we say in the trading halt, we're doing a capital raise, so that'll be complete and announced first thing Monday morning. But I think in this environment, we've got a very, very positive silver market going forward. You've got the likes of Citigroup and Goldman Sachs and others with a very bullish agenda on silver. The supply-demand issues that are out there at the moment are showing a real pinch going on, but that's more, the idea of a silver squeeze that's been purported out there just recently is not something that we really buy into, but particularly the more the credible commentators out there that are focused on the supply-demand issues are real, and there's a fundamental issue. You can't buy physical silver at the moment; it's just not out there. So going forward, we've got a particularly positive market, and that's highlighted by some of the big commentators in the market. So I encourage people to get online and have a look at some of that. We've got full exposure to that. There's a few smaller companies on the ASX. We're the largest pre-development. The system is tremendously large. We've got an aggressive exploration going on. So I think us feeding into the accretions in the silver market going forward, we're nicely positioned, and that's going to be reflected when we come out of our trading halt on Monday.
And so the time frame to going into production and being able to kind of capitalize rather on this demand for silver, is that something you can manage properly?
Yeah, so we need to get through approvals first. So that, as I mentioned in the presentation, we're hopeful that the second half of this year will be through approvals. But in this market, the opportunities of financing a development like this are real, and it's our objective to get straight into it. And I think you've got to take the opportunities in the market when they're there, and that we're in a bull market for silver, and that's clearly there for years to come, as is gold. So I think it's in our interest and our shareholders' interest that we move very aggressively, whether it's in development or exploration.
And hence that's the reason for the capital raising, to kind of expedite that production process and moving forward.
Indeed.
Great, Anthony. That's all we have time for today. Really appreciate you coming on ShareCafe Hidden Gems webinar for the first time. Love to have you back in the second half of the year.
Thanks very much, Tim.
Right, thank you. Next up, we have BPH Energy, ASX code BPH. market cap of around $95 million. Company's had a lazy one-year return of over 1,100%. What does the company do? It is a diversified company holding investments in biotechnology and resources. That's an interesting and unique mix. We have with us the Managing Director and Executive Chairman, David Breeze. David, nice to meet you. Over to you.
Thank you. The slide that you see is Advent Energy. There are two principal investments in BPH Energy. That is Advent and Cortical. We have an approximate 20% interest in both of those companies, and further details on the ASX announcements that we've got. We have been some of the most actively traded smaller stocks on the ASX, and over 70% of our company's issued capital has turned over in a period of less than a week. And that's all because of two factors. One's the advances in Cortical, but very much the focus is on the potential drilling of the offshore Sydney Basin project at Baleen. The map really just shows that we're in proven petroleum basins, both in our Northern Territory area and in the offshore Sydney Basin. The thing that I'd like you to just look at is to see going from the Bowen Surrey right through to Sydney Basin, and you then understand the way in which these basins are put together. We have the capacity to move into carbon capture and storage, or more particular, the storage component of the carbon. The offshore Sydney Basin is recognised as a potential carbon storage area, and that would have a significant input, if proven, for the carbon reduction and the objectives of both New South Wales and federal governments. And of course, that's what we will also focus on in terms of both gas and carbon storage potential in the offshore when we go to drill. We're waiting currently for NOPTA to approve an extension on the permit. Next slide, please. If you look here, you'll see the black line. Really, it starts at Newcastle and goes to Sydney, and that shows the extent of the permit coverage. You're really looking here in the yellow and at the buried mountain, as I call it, the analog or the analogy to what we're looking at. So that's really the target zones, 2,000 metres plus subsea floor. The other aspect of this map or graphic shows right out to the continental shelf, and you see the continental shelf slump events, and I'll come through to those, but I'll just bring those to your attention. The real issue here is that there is a shortage of gas supply forecast, and in particular, it's gas at an affordable price. And we're ideally situated here because the Baleen drill target is just 27 kilometres from the Munmora gas pipeline, and I'll come through to that shortly. Next slide, please. This really shows the proximity to that Munmora gas pipeline and the trunk line which runs from Sydney through to Newcastle. And of course, Newcastle is where there is significant demand for gas in the industrial users there. But really, the other key facet here is that the Snowy Hydro has announced plans for a gas-fired power station, and the New South Wales government has also announced that pumped hydro, batteries and gas are a key component of their next stage of energy, and we have a potential source here for that gas into the energy grid, as well as for the industrial users. We really show here the Caloundra power plant precinct, but we could equally run a pipeline up into Newcastle. Next slide, please. All that this shows is that you have groups that have researched or looked at this area, including Santos, Ampilex, going back to 1991 and 92. And Santos identified 10 leads, and Ampilex identified the baleen lead as one of their major targets with a 1.5 TCF perspective. So we've got multiple sets of seismic, and I'll come through to a coverage of that. Next slide, please. What we have is hydrocarbon potential proven repeatedly across different facets of the work that's been done here in the basin, proven by industry standards. So that includes gas chimneys, HRDZs, AVO and reverse polarity and flat spots. So they're all key independent verifications of what we're looking at. And that's on multiple lines, B4, 15, 16, 17 and 18, where we plan to drill with our joint venture partner, Bounty. Advent has 85% of this permit offshore Sydney. Next slide, please. So the blue line here shows the 2011. I showed you earlier, the current permit boundary. Our zones that we're looking at here are 22 to 27 kilometres, if you will, offshore from Munmora, and about 30 kilometres south of Newcastle. You see there where the gas pipeline runs into both Munmora and into Newcastle. Essentially, we've done a 2D drilling survey, pre-drill survey over the top of baleen in the recent past, and that set us up to move straight through into a drill program once we receive the NOPTA approval. Next slide, please. The analogues that are shown here on this slide are really to other areas around the world, including Australia, of course. And I show you the Ormen Lange gas field offshore Norway. The illustration here is to show shelf slump events and pockmark fields adjacent to or above the Ormen Lange gas field, but the same events occur over Gorgon and the same events occur over offshore Sydney. Next slide, please. This shows you sideways on into an illustration of a graphic illustrating in the Gulf of Mexico. And really the point here is just you're looking at the deeper reservoirs. When those reservoirs fill to spill, then you get gas chimneys. When those shallower reservoirs fill to spill, then in fact you get pockmarks at the surface. And that's what is shown in the offshore Sydney Basin. And there was a major government research program run in 2006, and that's where we got a lot of the data. Next slide, please. And you'll see that here. And if you can just keep on clicking on that slide, because there's a number of other features that show up here. These are some of the features that came from the research that was done by the government. And they correlated multiple sites right the way through from south of Sydney, right the way through to north of Newcastle, where gas was seen seeping from the sea floor, and even to the south of Newcastle, a seafloor mud volcano there. And you're looking sideways on at the seafloor and down from there. Next slide, please. So we have here AVOs that have been interpreted across the entirety of this structural target at baleen running through to South Fish. And this shows you just how much technical work has been done. Next slide, please. Here we're showing an analysis done by Fugro, and what they did was to say at a 2,000 metre you have this element of AVO, and you can see there the structural target. Next slide, please. CSRI did work and showed multiple simultaneous amplitude, reflection strength, and other AVO anomalies. Next slide, please. And those are concurrent with seafloor seeps to the surface. Next slide, please. And this really shows the seismic line 18 where we plan to drill. Next slide, please. And I'll finish at that point. Oh, no, I won't finish. We've sampled the sea floor. Next slide, please. And when we sampled the sea floor, we had thermogenic source, and they were verified by independent analysis. Next slide, please. And again, that shows the thermogenic source. Next slide, please. And here you see the Surrett-Bowen Permian Triassic going right through down into the Sydney Basin. Next slide, please. And here is the drill target that we're looking at with a 6,000 acres of amplitude closure. And I think that just neatly uses up my time if I'm right. And that's the drill target there on B418. And perhaps just one more slide at the moment. Thank you. So we've got a proven petroleum basin in the Sydney Basin. In fact, the technical success rate there for finding gas is well over the 50% level. Thank you.
Thanks, David. We've got an extraordinary level of interest here in terms of questions being asked, probably the highest we've ever had. The first question is around PEP 11 approval timeframe. Can you give our viewers an update on that, please?
We've been through this process before where it's taken over 12 months for a NOPTA approval process. NOPTA have on their website a timeframe. The recommendation on the extension was given some months ago, and we're currently waiting for that approval process. It's just not appropriate to give a timeframe on the approval, but the permit runs through until that occurs, and we've applied under two different sections, if you will, or two different phases of extension approval for a further 2 years to enable the drilling to occur.
And that's a process that's managed by the New South Wales government, is it?
No, it's not the New South Wales government. It's called the Joint Authority, and the Joint Authority is the New South Wales relevant minister and the federal relevant minister. There was an interview on ABC radio this morning of Senator Pitt talking on ABC, and that's a good one to listen to if you want to be able to understand the process there. But in the net result, the legislation gives the final authority to the federal minister.
And there's a question here from a well-known analyst. The Sydney Basin has often been characterised by low porosity reservoirs. Is it likely to be different and better offshore?
So all of the research by Geoscience Australia and the New South Wales Government Department of Resources and other companies have all been of the same viewpoint. That is that the offshore Sydney Basin is likely to contain rock zones that are much higher in permeability and porosity than the onshore basin. And if you look at Norway as a good example, how many oil wells or gas wells do you see onshore Norway? 0. How many do you see offshore as close as 20 or 30 or 50 kilometres? A lot. Look down at the Gippsland Basin and you see all of the gas wells are in the offshore zones. And now that's not geological proof, but in reality, it's the reports by others on, and that's independent reports that show that permeability and porosity is likely to be there.
And David, we'll just finish on this, but The majority of the questions here are around this, these permits and these approvals, and I know we touched on it, but do you think there is a time frame that investors can look towards?
It's just not appropriate for me to forecast on that. Again, the best, a very good way to get a viewpoint on it is to go to the ABC, go to Wendy Harmer's program, and listen to the interview.
Great, David. And a very exciting story. We would like to follow up with some further content this week. We have a lot of questions that we don't have time for, but really appreciate your time in sharing your company story with us.
Thanks for giving me the time.
Great, thank you. Okay, that's all we have time for today. We have Novonix on next week and a couple of other companies. So once again, we're getting great stories from ASX listed companies. We hope this helps you make some informed investment decisions. See you next week.